And we're back. Today I want to talk to you about Main Street versus lower middle market deals, what that means for you as a business owner, who to hire if you have a Main Street versus a lower middle market versus something else type of deal, and how it affects financing and deal structure and more. So let's get into it. So, number one question is, who do you need to hire if you're a business owner? And we as intermediaries use a lot of different terms. So I just use the term business broker and intermediary, but you may need M&A advisor, you may need an investment banker. What's the difference between all of these? Well, I like the term intermediary because it really crosses all of the transoms. And it just says somebody in between you and the buyer. It's not really saying what size you are, it's just saying need somebody in between for this transaction. And you hear the term intermediary in some other spaces like legal spaces, and there's some real estate functions that use intermediaries, but it just kind of means in between, kind of like escrow in transactions means on the side. But if we dial it down a little bit more, there's different types of intermediaries, and business brokers tend to represent Main Street deals and sometimes lower middle market. And then when you get into lower middle market and upper middle market and giant type stuff, now you're looking more at M&A advisors. Finally, investment bankers don't touch Main Street. So that's kind of where this spectrum moves towards as you go up into deal size. So I still haven't defined what is a Main Street business. And to do that, I want to use this slide from the IBBA. I'm a fan of the IBBA's research. Essentially, the IBBA defines a Main Street business as anything up to about a $2 million purchase price. Now, if you have a business that's $2,001, does that make it a lower middle market? No, not necessarily. But basically, anything up to about $2 million in enterprise value, another sticky widget with that term, could be considered Main Street. And between $2 million up to around $50 million, that could be considered lower middle market. That would basically suggest that it's 50 to $250 million that could be considered middle market. There's really no definition of where middle market turns into the large cap type stuff. But chances are, if your business is less than a $2 million sale price, that's confusing because you may have to do $7-8 million of revenue per year to sell for $2 million. Depends on your profitability. Chances are, if your business is going to sell for less than $2 million, you own a Main Street business. And so, what does that mean for you? Let's break down a little bit about Main Street versus lower middle market. Now that we've got into revenue sizes, let's talk about who owns these type of businesses. I want to talk about ownership structure. With Main Street businesses, the majority of Main Street businesses that sell for under $2 million, they're owned by one person, maybe a family, maybe a couple of business partners. Typically, they're owner operating the business. Now, we have this fancy term called EBITDA, which we use to define what it would be like if the owners weren't putting their own time into it. But pretty much Main Street businesses are calculated off of what one working owner could take out of the business. That's called cash flow. We have a lot of names for that. Owner's discretionary earnings, cash flow. Main Street businesses say if someone else was to step into this business, this is the proceeds that they could take out of the ownership. It includes paying your health insurance, your life insurance, your salary, things of that nature. And we can distill from that what if you hired a manager, what the EBITDA would be. But that's how Main Street businesses work. And only when you get into lower middle market, businesses that are going to sell for $5, $10, $20 million, is it pretty common to have the manager's salary included. And the owner kind of takes a step back, and their owner's managing managers in this scenario. In lower middle market and larger businesses, typically the owner is paying him or herself a reasonable salary as an owner, like an employee of the business. And then there's additional monies that the business makes on top of that. So managers are paid, everything is paid, and what's left is the free cash flow coming out of the business. That would be considered EBITDA on a lower middle market or larger type of business. And when you get into bigger and bigger businesses, you tend to get more than just that working owner. You tend to get investors, investor groups. If you think about a Facebook, a Meta, one of these large, even Mark Zuckerberg doesn't own all of Facebook. When you get into these giant companies, it's unrealistic for one person to control it all. And it's because larger companies need lots of capital. They often exist over many different parts of the globe. And by their very nature, they have to be split up into smaller shareholder parts. So there's this ownership spectrum of what's it doing for the owner with a very small business versus there truly are shareholders in a lower middle market and a larger business. And what's the shareholder benefit? So that's a key difference, this ownership structure of who owns it. And it's for that reason, often you see Main Street businesses are sold as asset sales, just the assets of the business are sold. Whereas with larger businesses, we see more stock sales. Some larger businesses are sold as asset sales, but different owners replacing the ownership shares, taking ownership shares off of some individuals and putting new individuals or corporations into those shares is typically what we see with larger businesses. That's a fundamental difference. So we talked a little bit about ownership structure, we talked a little bit about the way the transaction works. I think it's how they are paid for. Lower middle market businesses are typically paid for with cash, seller financing, or SBA loans. Those are the three dominant ways that businesses under, say, $5 million transact. And the SBA limit as of the making of this video is $5 million. So it's hard to get them larger than that. Now, I'm going to talk about private equity in a minute, but I will say that private equity tends to be interested primarily in businesses that are $1 million in EBITDA plus. Sometimes $750,000, rarely $500,000 or less. We're seeing a trend for private equity to look at smaller and smaller businesses. But in general, private equity is looking at larger businesses. $5 million in revenue is a common thing, but that earnings piece is really, really important. And they're pretty particular about the type of earnings, the type of category, whether it's recurring. There's certain categories they just won't touch. But private equity will often pick up where the SBA lets go as far as financing options. It's a totally different type of buyout of an owner because often private equity is looking for the owner to stay involved or be involved in a long transition. So private equity is a different animal, but they tend to pick up and do more of the lower middle market and larger businesses. And then with really, really large businesses, it's often bank financing. There's all kinds of different capital structures that can come in with the larger businesses when you're talking about the stuff that happens basically on Wall Street, where Procter & Gamble spins off or buys a division of another company. Now we're well beyond the SBAs and the private equities, and we're into large banking plays. And that's where investment bankers are squarely brought in to manage that. The JP Morgans and the Chases of the world are doing those deals in the mid markets, in the large cap type stuff. So that's how businesses are paid for. And so I want to go back to this idea that larger businesses have different ownership and they have different demands on the owners. There really is no way for a single owner to manage a global multi-billion dollar type revenue business. I'm sure it's possible, but it's highly, highly rare. And the challenges that these businesses have is all around using their capital, using their assets to the most efficient way, and developing over different markets. There's different pressures in different markets. When you have a very large business, it's often a culmination of many different divisions of a smaller business. So that's where these pressures come in to basically split up ownership into smaller and smaller pieces, and you're operating almost like an ant hive, right? So it's more than just the motivations of a single owner with these very, very large businesses. You have multiple divisions, multiple markets, multiple pressures to generate profits, and I would say possibly some conflicting influences among the shareholders. Whereas with a Main Street business, there's probably one person watching the P&L. There's probably one major division if it hasn't been split up. So it's just easier to manage. So why does all of this matter to business owners? Well, it's important to understand what you have as a business owner so that you can understand who the buyer is and what type of representation that you would need to sell your business. If your business is less than $2 million, it's going to sell for less than a couple of $1 million or even under $5 million, it's possible that a business broker could be well suited to serve you. If the business is going to be multiple millions, tens of millions, hundreds of millions of dollars, you may want to look more towards someone with M&A experience. If it is a $1 billion deal, You probably don't own it outright. You probably have some partners in this, but you're squarely in the investment banker type of world. And it's going to be pretty obvious when you look on a firm's website kind of where their specialty is. You don't see some brokerages have divisions of Main Street and investment banking or M&A type things, but they're pretty different deals because the buyers are so different. And the last thing I'll say about this is buyers tend to come from much farther for the larger deals. There's a statistic in the M&A Source and IBBA about how far your buyer comes from, and it basically says that for businesses up to $500,000 that sell for around $500,000, maybe even $1 million in proceeds, the buyer's probably already within 20 miles. And if you go to the opposite end of that spectrum, if the business is worth more than $5 million, there's a much, much lower chance that the buyer is going to come from, over 100 miles away, because people will travel for the right opportunity. You got to know who your buyer is going to be in order to know who they are, in order to know what type of help that you're going to need to sell it. That's what I find fascinating about business deals. There's all different types of businesses, there's all different sizes, and there's all different channels that you can go down once you know all this stuff. I hope this has been interesting for you. I invite you to reach out to me. I'm Neil Isaacs. I'm the Raleigh Business Broker. I love to answer questions about business on this channel and on others. You can find me on LinkedIn and send me your questions. Put your questions below. And before you leave, check out one of these videos over here. I think you'll find it's exactly what you're looking for next. Until next time, mahalo.